we'll hand over to you, Ed Matt's Matrix student. I will be here though to interject with questions.
Button, and just give me a shout. Shout every 15 minutes. 15 minutes gone. Otherwise, we'll be here until tomorrow, and that'd be very rude for the people.
Yeah, I will do. Okay.
Yeah, thanks, Simon, a lot, and welcome and good morning, everyone. How to trade the UK election? Notice how it's slightly slanted to the left. There's nothing about the UK election that's slanted to the left. Just a brief summary of what and who I am and what we are, Matrix Trade. Essentially a macro trading and advisory service on foreign exchange, stock markets and commodities. I started off life out of university, went straight into a foreign exchange dealing room, and soon learned that there's no good being right in the wrong market, that my economics would pretty much not help me make money. It might help me understand what's going on, but wouldn't help me trade it. And through that experience working at Citibank and through various investment banks, went into my own business with two other guys. Effectively, since then, moving to a position where now at Matrix Trade we focus on evidence-based research. And by evidence-based research, that's analysis of what the markets are doing, what we believe they're doing at least, but also evidence-based trading. How do you therefore translate that into a trade? Because one thing, as an aside, one thing I'd ask you to bear in mind, any takeaway from my talk today is a view is not a trade. You can have a great view, but not be able to trade it because the risk-return parameters, the risk management issues, and in fact the how you frame the trade just doesn't work. So what we try to do is we take that analysis and we try to quantify that into a trade, into forecasts and in fact trades. So let's go step back and say what really moves markets. It's interesting, on the weekend I had the pleasure of being on a panel that was ostensibly about the UK election, and the very first, and it seemed like the only question is how do you trade an event like the UK election? Should you look at the fundamentals, the politics, what's really going on, or should you just stare at your screen, base it on price action and technical analysis? And again, interestingly, I think pretty much at least 3/4 of the people on the panel answered, forget everything else, just look at your chart, Shag. Which reminds me of a phrase. I went out for a beer once with some guys at Old Goldman, and I was a technical. Once I threw away the economics and started focusing on what I thought would help me make money was technical analysis. I developed a bit of a name as one of the pioneers, in fact, of Elliott Wave, certainly in the London Forex market. But just generally a pioneer of technical analysis of foreign exchange. So I was known as that. So I went for a beer with some guys from Goldman, and I remember this very well because they said, or in fact one particular person, Simon, said, Ed, put your charts away. It's about the weight of money. Money talks. In other words, you can have a chart, you can have a view, but if someone comes in with a wedge and buys against your selling point, you're going to struggle. The reason I mention that because pretty much the very next day I had a sell signal on dollar yen. So I went when I was about to sell it, and then Goldman came in and by literally it was about $800 million yen. So I thought, well, my sales signal's wrong, and lo and behold, it did go up by 20 points, but the next day it was 150 points lower. So it's what really moves markets. It's a combination of different things. It is the fundamentals. I mean, talking particularly about the fundamentals today, or if you like the UK election, which is what I'm talking about today, what is really going on. And there's, if you like, there's two underlying themes. One is, and the obvious and the headline theme is Brexit. And the second one is the machinations and the political result from the election that will have an effect on what we do in Brexit. In a nutshell, well, I'm going to assume or presume or whatever that the Tories are going to win. I can't foresee, and I don't think anyone else can foresee of any other result. The issue essentially, as Theresa May says, is a hard but smooth Brexit. In order to do that, she's called the general election early. Several reasons why she's done that. One is so that she can pursue her own agenda, have her own mandate rather than David Cameron's mandate or George Osborne's. There's a few things in the budget that she took great exception to. As an aside, on a personal level, which is why George Osborne's not there anymore. But she's now in a position, provided she wins, to pursue her own agenda, which is, sadly, I would say, not Singapore on Thames, not a free market, low regulation, low tax economy that I would love to see Brexit as an opportunity to provide. The UK could be something quite special, use Brexit to its real advantage, but rather shifting the Tory party centre ground and squeeze what is a pretty dilapidated, poor showing of a Labour Party at the moment out. So when they come back through Miliband or whoever, they're going to find it very hard to recapture the centre ground, and therefore to differentiate, they'll be back on the left. I hope I'm not boring anyone with this, but that's what this election is about. Enables her to pursue her own agenda. Now, when that comes to Brexit, this is the crunch. When it comes to Brexit, in order to pursue a hard but smooth Brexit, which really, bells and whistles, forgetting about passporting, which is an issue that no one really is talking about, which is massive. Massive for the likes of you and I, and how that knocks on for the banking industry and a lot of my customers. It is essentially about where this country can position itself. In other words, are we going to be in the single market, or are we going to find some compromise, or that allows us to be in the single market, buy our way in, or be out of it? And what the result of the general election will achieve, if she clears, which I think is going to be close, if she clears 100 majority, that will enable her not to listen either to the Remainers, the Ken Clarks on the left wing of the party, or the likes of the David Davises and Boris Johnsons on the right, who are pretty much hard Brexit. It will allow her to steer her own course, and therefore, more importantly, if she gets the majority of over 100, she will not just be sending a signal to the newly elected candidates within the Tory party that she is control and it is her Brexit, but she'll be sending a signal to Europe. And when it comes to negotiating, and it's going to be a very long, drawn-out, difficult negotiation process, they will take note that she has a mandate. Just think, if she hadn't called the election, then she would be negotiating up to within a year of the actual Brexit itself, and therefore be mindful, and the European politicians, and there are a few, I'm not going to say any rude words, members of the European Union political bureaucratic organization who would seek to take advantage of that. With a clear mandate, you can say, no, you need us just as much as we need you, and therefore these are the terms we think we should agree on and can agree on for the benefit of all. So the best result for everyone is for Theresa May to win by a majority of 100. And the first thing you'll see, if she does, is you'll see one or two of the three clear, the David Davises, the Boris Johnsons, they'll be out of the cabinet. So that's the fundamental framework that, that will, if she wins a strong majority of over 100 or thereabouts, we'll get an aggressive sterling spike, and we'll get FTSE up higher as well on the back. UK assets will like that because it shows a strong, effective government, which essentially is what this election is about. How that affects other markets, or how it will be affected by other markets, the other strain, we look at four things at Matrix, what we call FITS analysis: the fundamentals, the intermarket relationships, in other words, gilts. Gilts will love the same result. It'll be a UK plus day if we clear 100-seat majority. If it's anything less, let's say it's around 50, then she'll be like buffeted by the wind of politics. She'll have to compromise left, not just left and right, but also in Europe, which will make the whole process very uncertain, and markets hate uncertainty. The third aspect of the FITS analysis is the technicals, and how analysis is essentially a geographical representation of, if you like, of the golden weight of money, of supply and demand, and therefore gives us an indication based on what markets typically do in the technical formations as to what they might do in the future. Now that's an important premise. What markets do now is nothing new, even if though the details may change. Our technical formations, and we follow them for a simple reason, is that they've worked in the past. And the reason they work is sentiment. It's you and I making decisions based on fear, greed, or otherwise complacency, and therefore we will make decisions based on that sentiment. And that is just, at the end of the day, it is the Goldman's way to money. It's what actually moves markets. So how do we frame that? I might just very quickly to give you an idea, because it's all very well talking about evidence-based analysis, but we take the view, our analysis, and we apply it to a trade. There it is, a view is not a trade, trying to identify the right risk-return parameters. I'm mentioning all this because it will frame how we, or are, and will trade the UK election. And the reliability of that approach, the reliability of the formation, and if you take something like the Eurodollar or DAX, they hate head and shoulders. 73% of head and shoulders in those markets fail. And yet, if you take a market like a dollar yen, when it's in trend, it only corrects 23.6%, whereas stable will correct something anywhere from like 75 to 95%, which is, you know, anyone who trades cable will know that is the case. And therefore, once we have our risk return parameters and we know the probability, the likelihood of success of that trade, that will help determine how much we put on it. And therefore, and thereafter, the discipline that we apply in maintaining that trading strategy, and the 3 Ds of discipline are discipline, making sure that emotion or surprise events don't actually steer you away from your own strategy unless they impact that strategy, impact the underlying edge. And lastly is the edge not just from the analysis but also the trading. In other words, learn from the lessons and mistakes we made previously. Evidence-based trading. So essentially, just a quick run through. I would suggest, because I don't want to take up too much time talking about this, anyone who's interested, I would actually, this is an old PowerPoint which shows us there is a free trial that's just been applied now actually for a free week's trial of Matrix Trade. Where we get our trades from, based on, I'll show you the analysis, some of the trades we've got on now for the UK election and going forward, is based on the simple metric. It's the risk return parameters. So multiply the probability of success of that trade, not the success or the probability of a market going up or down, but the probability of that trade. And by multiplying that, we get a payout, which we multiply by 10. If it's over 15, for us, it's a trade. If it's below 15, say 10 to 15, it could be a trade. I do a lot of those trades myself, but we don't signal them. We do signal our trades. And if it's below 10, it's a no-go. In other words, the view is not a trade. Just to give you a quick example, running through 3 to 1 times 70% probability of trade success, that's a good trade. 2 to 1 with only a 65% probability is drop below 15. A lot of people will take that trade. I actually may well take that trade, but I won't signal it. And let's say it's a 2 to 1 with only a 40% probability. You see a lot of those trades. No aspersions intended, but you see it a lot in the retail market, particularly amongst new traders. And your question is how you identify the probability. Well, one way you identify probability is through history, not just history of the markets doing that, but also the history of that trade succeeding in that type of market. So we used evidence-based trades. Funny is, essentially, it's a quantitative approach to qualitative analysis. I've been doing this for over 25 years. And why am I still doing it? Because I just simply love it. I'm very, very passionate about markets. It's I think it's Paul Tudor Jones who described trading, and certainly macro trading, as 3-dimensional chess. Every day it's a puzzle. Every day it's a new puzzle. And with the complexity of the current market, I strongly believe we're in the final leg of the dollar downtrend. We're in the final leg of the stock market uptrend. And at that point, the correlations break and the intermarket relations break down significantly and increasingly. And anyone who's tried trading correlations of late will know that is definitely the case. And because of that, it's actually much harder to use one market as an approach to another. And it essentially becomes an increasingly difficult puzzle unless you understand that those correlations breaking down actually means nothing, and that it's actually all part of the same story, that we're entering the last stages of the third largest bubble in stock market history, certainly in the US, and therefore that has implications for the US dollar. Moving on. Finally, deep breath, we finally got back to the UK election. So I've given you the background what I think is at stake in the UK elections and how the markets will react from a fundamental point of view. Now, you will find many people will be arguing the dollar's turn, sterling is a major uptrend. The UK election, this is a major buying opportunity. Brexit is going to allow Brexit to help this go through smoothly, and uncertainty will fall, and sterling will be going up in a massive return to the uptrend, up to much higher levels. You'll also find, by the same token, you'll find people talking about sterling being in a downtrend because of Brexit, and that Brexit implies and since June the 23rd has implied a downtrend, that once the UK election is over, that sterling will be able to rejoin its downtrend and go all the way down to the 103.50 low. I can give you countless reasons why both of those might be right or wrong, and the simple answer to the question is, well, where's the evidence? When anyone presents you with a view of a market, as you would do in life, I'm sure many people here listening in today don't trade full-time, they're part-time, and they probably lead very successful careers elsewhere. And one thing they will do is any major decision they make when they put money on the line is they evidence it. They do their homework, and therefore it's based on that evidence that they then take a decision. Why are markets any different? Why is it when you trade a formation, say in dollar sterling, a head and shoulders or whatever, or you think it's a trend and you're looking for a minimum 23.6% pullback, why is it you or someone else who's provided you with that view or trade hasn't actually done the research or the evidence, provides the evidence for what sterling normally does? And going back to the UK elections begs the big question, well, what do UK markets normally do during the UK election? Well, let's start with what sterling normally does on June 8th. Can everyone see that? I can't, obviously you can't shout, I can't see that. That's the case. Simon, can you see that?
Yes, we can see it fine, thanks. Great.
Okay, now what you can see from the chart in front of us is what sterling has done on average through general elections. I don't know if I can see this. Just to show you, the red line is what sterling does. This is 100 days before the election, and you can see with the prospect where there's a possibility of a Labour win, sterling declines and then recovers into the election. This is where we are now. On average, because of obviously there have been quite a few Labour governments, has had an impact on dragging it lower before it rallies into the election. And as we well know, it has rallied into election. But obviously the most interesting one, the one we're really interested in, is what happens when the Conservatives win. And we have shown that the light blue line is what happens when the Conservatives win, but also when the dark blue line, you notice is higher and more bullish, is what happens when there's a significant Conservative majority. And essentially it's followed the Conservative victory, well, there's no surprise there. But it's also followed a strong Conservative majority. From the moment Theresa May announced the election, it's followed this average, the average of Conservative strong majority wins. And you can see that it started consolidating exactly in the same place. So it begs the question, what happens afterwards? And as you can see, the Labour actually sees it recover, albeit slowly. But going into what we're really interested in, what cable tends to do historically on UK elections when there is a strong Conservative majority, and you can see that it consolidates, comes off into, because market nervousness, and then spikes into the election before it comes down. So there we are. We have the Conservative typical average, the average of Conservative majorities, what this means for cable, and obviously where this is above 130, just above 130, and sells off into the election and rallies again. So essentially what we're looking at is one final spike, a buy the rumor, sell the fact spike. And typically I would frame that, the mantra I use is not buy the rumor, sell the fact, but buy the rumor, buy the fact, sell. In other words, you get the reaction, a bit like the French election. First reaction is it's marked up higher, people come in and buy it again, the market moves even higher again, and then you get sell the fact, it's delayed. And essentially what it says is for the week, or I think probably longer in this case, and I'll show you the reasons why, it will come all the way back down. So going into elections based on this alone says that we trade a range into the market, so beggars belief why people are looking for sustained trend before the election itself. But we trade the range, and what is that range? I'll show you in a minute. Looking for that final spike on the election in order to sell for the break back down. Pure and simple. One of the reasons why I'm looking at this particular formation is we go back through, okay, we're trading an election and we're trading cable on the election. What has it done historically? And we'll look at each, not just the averages, because the averages contain, obviously by definition, contain a whole host of possibly very different elections with different impacts on the market. Well, the one it resembles the most, it's actually one I stood in, Oxford University, Oxford Western Abingdon. Was the run-up into the election was, if we look at the period 98-2002, this was the election itself in June. It sold off before the election quite aggressively and then rallied thereafter. What we appear to be doing, and I think this is explained by the uncertainty surrounding Brexit and therefore how Theresa May will position her party and the government and this country on Brexit after the election, we'll actually see some uncertainty until that's clear. So what this is an old chart, apologies for that. What it's basically saying is this is a correction that from we now know from the 120, 127 range, it will spike up into the previous consolidation phase. Let me just see if I can zoom into Simon, you there?
Yes, over here.
Just seeing if you can see the this chart. This is I always get asked this question whenever I put any of my charts up. What's this trading platform? And it's a Reuters icon. I've been lucky enough to be provided with an icon for many years, so I have no reason not to use it. That's part of a long. Yeah,
we just got a comment from Richard. He says, this time through complications of Brexit negotiations making cable a lot more volatile. After the elections, perhaps better to stay away from the GBP pairs. I think that concurs with what you're saying.
No, not at all. I'm saying that it's a trading opportunity. That sterling is. It goes back to the Panamas on the weekend that. When it's uncertain, the actual real world's uncertain, then you shouldn't trade it because it could impact. And what I'm saying is that the real world events, developments for elections are quite typical, and that people are confronted with the same, obviously very different questions in detail, but essentially they're the same. In other words, we need the election out of the way to get the result, particularly, but if it's a well-known result, then we also need to know what that confirmation of the result before we can get on with our real lives, if you like, but what the market is going to do. And that shows over history that sterling does a similar type of thing, particularly with a conservative majority into the election. As soon as the election is announced, remember we've only had one fixed term announcement, if you like, but all the previous elections have been announced by the Prime Minister of the day. And all of those have had an impact, particularly for a likely Conservative majority of rallying on the announcement and then consolidating into the election, spiking higher and then coming off. And if you look at this in terms of the, it's quite similar, in fact, to the Brexit run, very similar, in fact, short-term price action just before Brexit at the moment. So it's saying that cable is setting up a top. Just to give you the context of just a couple of things if you want to look at. We look at interest rates differentials, and there's time lags on that. Cable is actually 47 days behind its 3-month forward, which is kind of weird and wonderful. We also look at volatility, saying that we got a spike up and then down, which is consistent with the view of a new low. Where are we coming from longer term? It's very similar price action. This is a chart of the last 30 years of cable. And we're doing something very similar to the period from 1991 into 2001. And this is, if you recall the chart, saying we were looking at a very similar election, it is this yellow circle. If you look at this decline, it's a three-legged decline. Consolidation breaks down aggressively, consolidation breaks down aggressively, then forms a slow bottom, head and shoulders. You can a rounded bottom below the previous low, as we are now, below the Brexit low, and then breaks up. What it's essentially saying is this election will provide us with the buying or the sell-off after, to provide us with a buying opportunity potentially of a lifetime, but certainly potentially of a generation, and potentially for the next 1 to 3 to 5 years. So when Simon asked the question, we should stay away? No, not at all. It means in the shorter term there are selling opportunities, but it also means that we're unlikely to break this 103.50 low here. Let's put it down there. This is the all-time low on cable. And that any sell-off to new lows is a buy against the low. Well, that's going to be about 13%. So I don't know how big your pockets are, but obviously we need to fine-tune that. Again, that's a trade. I'm not going to buy cable at, say, 116 and with a 103 stop because it doesn't make sense. But we will look to time and fine-tune this period through the Brexit uncertainty. Coming out of Brexit is good news for sterling, which is good news for us. As UK, I'm sure there are many listeners from outside, but certainly from a UK perspective, it's positive news. So going back to the shorter term, what this actually implies for cable, going back, is this is quite similar to a much slower version of the pre-Brexit. The UK election is doing a slower version of Brexit. Now, what is interesting, and one thing I think is very interesting, is that people are still in a mode where strong hard Brexit news is a sterling sell, because from June the 23rd, when there is an indication of Brexit, cable went lower, and when there was any doubts about Brexit, when people started talking about another referendum or it was unclear what was going to happen, sterling rallied. In other words, uncertainty that Brexit represents actually was strong, stable for sterling, and greater Brexit uncertainty was bearish. Since Theresa May made her speech in January, I think it was January, sterling changed that mode. Whenever there's hard Brexit news, in other words, greater certainty about us leaving UK, leaving European Union, that has essentially been good for the pound. And that, for us, was one of the preconditions of our view that sterling is close to, but not necessarily at, a major bottom. In other words, going back to that point about in the final legs, the correlations break down. The correlation of harder Brexit being bearish for sterling has inverted, has broken down. The correlation now is stronger news for Brexit is stronger for the pound, and that is ultimately a key fundamental intermarket relationship, is showing the way that sterling is close to a major bottom. But as we've seen in the last few days, in if you want to use the Trump-Russiagate story, for that move to happen, the market has got to be positioned the wrong way and not the right way, and there are far too many sterling bulls out there at the moment. Why anyway?
Sorry,
Yeah.
I think maybe there's a disconnect between the slides we're seeing and what you're discussing. We are still looking at the PowerPoint preview of the cable 1998 to 2002, 2015 onwards. Is that the wrong?
Yeah. Yes, it is. What do you? Let's have a look. What are you seeing now?
We're still looking at the same thing.
Well, let's go. Okay. Yeah, let me try and get back to how do I do this.
You need to put it into PowerPoint presentation mode, which is just round about the bottom right. You'll see a projection screen, or actually, sorry, you're on this top left on this version. You'll see a little icon of a presentation screen. Yeah, further up, move up, move up.
Oh, you're there, are you? Oh, okay, that's no problem.
We're looking at your cursor.
Can you see a new chart?
There we are. That side. Yeah. Okay.
Unfortunately, I'm not the most technically able person as far as I've got multi-screens, so I'm looking and talking about a chart that no one can see because it's in bottom right. So I've moved it back into. This is essentially what we're looking.
Yeah. If you could explain what, first of all, just what some of these trend lines and things are that you've got, because it's quite a busy chart. So maybe if you could take a second just to explain what.
Quite.
Yeah.
But from the top left, you have the ramp into Brexit, which we're actually following on a much basis in the last rally. Into Brexit, into the event itself, and then it crashes. We're doing and arguing something similar, but on a much, much slower basis. This rally, even though we think, let me just go a step back, even though we think sterling is close to a major bottom, I was explaining before, which you obviously couldn't see, how this is very similar price action, breaks to new lows aggressively, consolidates the bottom, breaks back up, breaks to new lows, consolidates aggressively, and breaks back up. I think a lot of that is actually a dollar downtrend rather than cable, but it still ultimately says that Brexit is good for sterling. Now going back, this is zooming into that chart. What we're doing now, it actually says therefore that this is likely to be, this is still a correction from the low, and that we've got one final wrong footing move to the downside before sterling turns. And it's quite, we've already hit, just to show you this channel, we are pushing the top of the channel. Now, the problem with this channel actually is it stems from the fat finger spike. So where was the fat finger spike? 118.15 people seem to agree on, but there are all obviously lots of different levels as to where we come from in that respect. But essentially this is, I'll just sum this up. This, we believe, is the last correction in the downtrend or the sell-off. And that we are looking for a major buy, but we think this is a sucker's play to the upside. And that I used the example of last week with the Trump Russiagate, of how if for a market to move aggressively, it not only needs people on board and those people buying, in this case we want it to reverse sharply, but you need people short. And the most powerful combination there is when people get themselves short but actually believe it's bullish. So in other words, not only when they stop out and buy, they'll actually buy more, and they have a willingness and disposition to buy more. So you look at markets like the dollar-yen rally from 2011 upwards. People were very bullish. Retail, in fact, was very bullish at the bottom, and as it broke higher, they bought some more, and then it went a bit more, and they started selling because it went too far too fast. Even though they believed it was going higher, they found themselves short. So not only were they going to stop out and buy it up more, but they're actually going to buy into it as well. And that's when you get dramatic trends. It's when people actually believe the market's positioned wrong against their own view, and therefore they go back to their view and fuel it even more. So to go back to this, what it's essentially saying is we are doing a slow version of the pre-Brexit price action, and that going into the election, it's going to do nothing for the next 18 days until it spikes up on buy the rumor, buy the fact, sell. And interestingly, there's lots of things, as Simon says, it's a busy chart, and apologies for that, but these charts are like a working, for me, they're a workbook, so I need to retain the, although I've got actually got a photographic memory for charts, but I can retain a lot of the information. It's nice to come back and say, oh yes, there's this and that, there's that, etc. So I know what's going on. We are at the top of this up channel. The up channel section for the last, let me find out how to tell you exactly. It's type of weird, boring, anorak thing I do. For the last 164 days, cable has been traveling in a slow flag updrift. Now, forgetting anything else, politics, intermarket relationships, sentiment, simply it's saying this is not as yet an uptrend. It is slow, and therefore it should be bearish. It's a down flag, and therefore you have to ask yourself, will it do what is a textbook down flag and break to the downside and then go the same distance again, which you're talking about 9 big figures, which is 111? Or in our case, what we believe it is to be far more muted, because history shows, going back to that original slide, that the final new low was very, very slow. See how marginal that was? That was pretty much only 3 big figures. So we're looking for marginal new low, 300 points marginal, 300 pips marginal, but looking for new lows. So our trading strategy going into the election on cable and cable alone is to we're trading the range 127, 130 and change. It has already met the first objective, effectively this level here, the 38.2% retrace at 130. In fact, I had 130.45 on another chart used, going back to the, where you put this fat finger low, 130.45, and we sold 130.40 with a stop at 131.40, 100 points for 116.95, 115.95 rather. That is our target. Now, unfortunately, if you remember the election average, what it says is that we go sideways into the election and spike. It means that it's already met the objective before the election and that we're likely to get a further spike later, and therefore we'll get stopped out. So in the shorter term, we're looking to exit this strategy. That is, obviously at the moment, we have what is effectively it's about a 15-to-1 risk return. Now, you can attach a low probability of that of only, say, 33%, and that's still a massively good trade. But unfortunately, it looks like we're going to get stopped unless we do something about it. So let's go into the shorter term on cable and cable alone. One thing that cable, again, going back to whatever market you trade, ask yourself, what does it do? What does it do in trends? What does it do in consolidation? What are the powerful, successful formations that work in the instrument I'm trading? Not what the textbook tells me about all markets, but about the market I am trading. And once you start with that as a parameter, it is amazing the difference it makes to your trading, because you then start to understand not just the formations that work, but understand possibly why. And that cable is buffeted by more than just sterling at the moment, but also by the dollar, but also by the interrelated markets, namely gilts and FTSE. And that's why you were not seeing clean price action. But it's also why one of the cable's favorite formations is actually quite a rare formation for many other markets. It's an expansion. And from the 129.05 high in April, cable has been ratcheting higher, could be a wedge, you could argue, but what is more likely, given it likes to do it, expands the range. Now, an expansion reflects two things. It reflects a lack of upward momentum, which we think is necessary. Obviously, if we think it's a top and it's within that broad up flag, but it also represents increasing volatility through increasing uncertainty that Brexit, but more importantly, the election represents. So what it means is, in a nutshell, cable is a pig to trade, because what it should do is just stuff every obvious level. An expansion will take the highs, it will take the lows, but actually not go anywhere until you get the final dramatic spike to end the expansion. And as the expansions have 5 legs, starting from this 29, we think there is one more downside into the election before that spike higher. So why I'm trading cable, given that it's such a whippy market, is because I'm pretty convinced, I'm very convinced what this market is doing, and that is that expanding range, which will probably take out. You've already seen it the last week with that initial spike down from above 130 as the market got long and long, back up to the same levels, and yesterday we spiked down again, and then today we're even though it ramped on the back of hot air, on the back of FOMC, Fed minutes yesterday that were arguably dovish because they didn't commit to this tightening that people saw, even though it meant balance sheet reduction, dollar weakened, and now it's strengthening again because it is hot air. And what we'll see is 128, 129.30, 128.90, 128.70 and 128.30 all blown out the window before the election, and it means nothing because it's 127, 130 and change. And once that's run its course into the election, then everyone again long and wrong more dramatically up to a target we now have of 132.60. So what it essentially means is how we're trading this is our risk return parameters are spot on to stay short. We could actually get away. I think we'd get away with even though we're short at 130.40, we could get away now with the 130.50 stop. In fact, the other day I lowered it to 130.50 and thought, this is too whippy a market to have such a tight stop, so put it back up to 131.40. But what it means is that going into the election as it comes off, we'll look to buy, and we'll look to buy as close as we can to 120.60 with a stop below 127.10. You can see that there. That's the top of the previous range, which you shouldn't get back below. As soon as it gets back below that level, it's back into the range. And basically there are three major trades here. The first one is to be short now, as we are selling rallies against the 130.45 fibber, looking for 127-ish, 127.60, looking to buy against 127.10. That will give us for a final new high. 132.60 is 560 pips against the 60 point. That's an 8-to-1 ratio. Risk return reward ratio. The probability of that trade working are reasonably good. They're going to be around 50%. What, 50% only? It's not of the view working, but also of our trade working, of our stop surviving that sell-off into the ramp. And that would be a great trade. But more importantly, will be to sell 132.60 against the 134.85 previous corrective high. Now, if this is still a downtrend, then given the ferocity of the previous move, the cable should not trade above that previous corrective high. So if we are right to believe that cable is going down to 115.93, we will look to sell 132.60 with that's 220 points away. So we're talking 250, that's 2%. So we'll reduce our position size because we don't commit more than 1%. We'll try not to commit more than 1% to any one trade, even though I came preciously close. In fact, I did that this morning on buying DAX. It's time to have conviction. Once you have conviction, then you're essentially saying the probability of the trade is actually is higher than the historically would suggest otherwise. Anyway, that's we'll look to do that, and then we'll look to run it down in line with election average. If you recall, the election average, which is on the wrong slide again. Simon, you there? Just to help me out technically here.
Yeah, what are you trying to...
Are you looking at FTSE now?
We're looking at FTSE 100 election performance slide.
Is that just the one whole picture?
No, it's on the preview. So you need to switch
so
it. So
you can see all this stuff here as well.
That's right. Yes.
Yeah. Well, not to worry, unless I can somehow move that. Oh well. Far more interesting getting the market right than not getting my PowerPoint right. But anyway, okay. I hope that's clear. Bottom line, let's recap on cable. Cable is therefore let's get the Reuters chart up. Cable's consolidating, expanding, whipping. One thing I'm not doing, and I should be doing really, is taking 50, 60, 70 point pip profits on cable, because it's going to come back into the elections, go up, down, left, right, sideways, and whatever. It's more of a scalper's market than a positioner's market, a swing trader's market. But I'm holding out for 127 because it is so whippy. I got no idea when it's going to break down, quite frankly. And therefore, I want to be short when it breaks down, and guaranteed if I think it's bottomish at 129.30 for another 70-point rally, it'll probably break. What I should do, and as an aside, I should take back 10% of my position, because it's amazing how many times when you reduce your position size, the trade works, but that's besides the point. So basically, I'm trading the range, looking to buy 127.60, with a stop below 127.10. Should really be 126, but below 127.10 if the timing is right, and we'll signal whether the timing is right and try to fine-tune our risk return as much as possible for that final election ramp. And I would like to think, from a political perspective, that it will be a Tory majority of over 100, and that we have got the beginnings of a very sound political framework for our negotiations with the EU and a smooth, hard Brexit. But I will say that we got the Brexit view entirely right, but I thought it was going to be a Remain vote. For the simple reason, we were looking for this last rally because, funnily enough, it repeated what Eurodollar did into the Grexit referendum. In other words, spiked the top of the range and then came off. So I was thinking, why would it spike the range? Well, that's probably because we vote Remain, and then it'll be a buy the rumour, buy the fact, up, sell. But lo and behold, in fact, it spiked before Brexit 150.15, looking for a spike above 115 for another attempt at the lows, and we know the history. So it's from the next new high that we'll start trading it down. Now, given the history of what it did in 2000, that was a slow, laboured decline into the final new low, where we'll look to buy it. Now, the difficulty will be, once it goes to new lows, the world and his wife is going to be bearish, which is perfect from looking for a bottom. The sentiment will have the fundamentals we believe on our side. Hopefully there'll be an indication, at least on the UK stock market, if not gilts, probably on gilts more so, and therefore on the differential, that cable was trading against the differential. In other words, it's defying it, saying I don't believe it. And as the market gets bearish, we'll have everything else telling us we're right to buy. The difficulty will be measuring the volatility. Volatility is the hardest variable in any market to gauge. As you were, anyone who traded this, was involved in this fat finger will recognize volatility when they see it. We could look at something similar. We could be a soft landing. But either way, we know previous historically went by 300 pips, so that's what we'll be looking for, and we'll be looking to fine-tune that trade. I have 8 minutes left. Amazing, I've spoken for 50 minutes on cable. But let's have a quick look at the UK market. Let's do beforehand. You can see that it's pretty much all the averages are doing something similar. They're rallying into, when it was announced, it rallied, but generally they rally into UK elections for the 100 days previous. Even under a Labour potential victory, it remains relatively stable. And then starts ramping close to the election. This time, we've seen essentially what we saw. It was twofold. One is the Trump Russiagate, but also it was the sell-off, the first sell-off from 2400 S&P that dumped, and the post-French election dump that's taken the UK average slightly different. It actually does look like an outlier. Anyway, bottom line is it's approximately following. Now, what does it say for the election? It says that we ramp. We follow the price action, the averages pretty well. It's the same story. It's buy the rumor, buy the fact. Whoops, buy the fact, oops, sell. Up to 12 to 15 days afterwards, maybe even longer, depending on one other factor, which I'll show in a minute. FTSE should ramp to new highs. Today's actually squeezed marginal new highs, but it looks like it's going to still probably trade sideways into the election, ratchet higher if it's just an ordinary Conservative victory or an election day. We're talking 4%, so you know it's 280, 300 FTSE points. So we have a target 76.40 for that market, but I think that could be blown out the water as it ramps higher and then sells off aggressively. Now, given that I presented a case, hopefully presented a case, an understandable case, and apologies for the technical omissions if you've struggled to follow it, that the UK will come out of Brexit shining. It will come out shining on a relative basis for one simple reason. What we're looking at here, bear in mind that we're talking about sterling going to new lows and then sterling rallying aggressively. We all know that since the election they've had sterling cable and FTSE have had an inverted relationship. So this could just be a reflection of the dollar sterling rate going higher. In other words, FTSE in US dollar terms is stable, but it's sterling that has turned it aggressively lower, and I mean aggressively lower. But the overriding, I've talked UK election here. UK elections forms part of a much broader and wider and quite frankly far more exciting story. We've been for the last 6 months in since Donald Trump's election. It is 6 months, isn't it? It feels like 5 years, quite frankly. The last 6 months we've been in a Trumpflationary or perceived Trumpflationary uptrend since Donald in stock markets and in the dollar, you could still argue, and in the yields, you could still argue. But as that's part of what we believe, as I mentioned before, is a 7-year, 8-year uptrend, the biggest stock market bubble in the US, in the third largest in 100 years. Now, I'll explain simply why I'm showing you this. And this is a Greek model of the Dow Jones for the last of that bull market, and how it fits in. When the market is now nervous, and we're entering the final stage, essentially a new paradigm where everyone believes it's going up forever. There are lots of people still bearish, a lot of people still short. We tried selling it and failed, but we had underlying longs for this big blowout to the upside. As we broke higher today, it is saying we have entered the very, very final stage of a market that is truly aggressive both ways. We've been here before in history. Where is the evidence for what I'm saying, that it's a bubble? The price action is mirroring the 1920s and the 1980s. Okay, that's cool. A lot of people have said that before, but we've actually ridden it bullish all the way from the bottom up to this point, to the point where absolutely, if there's one big trade out there, forget cable. The one big trade is the trade, the US stock market, and therefore, if you like, it's related FTSE. So the reason why...
Could I interject for a second, just to give you a two-minute notice, if that's all?
It's fine.
Thanks.
It's fine. I've for once I've timed this to perfection. Yeah, I wish my trading was always timed to perfection, but we like to top tick and bottom tick. So the 2-minute countdown's perfect. So the reason why I'm showing you a US market is because that, when it comes down to it, at the end of the day, you should trade what is, or be mindful of what is really driving the market. It is not UK, as far as the UK is concerned, it will not be, in our belief, it will not be Brexit that will drive UK markets. It will be the US. It will be the end of what has come, we call the Trump bubble, Trumpflationary bubble, if you like, but has been a bubble in the brewing for the last 8 years, to the extent that it's following price action so closely. Now we have a calendar chart of day by day what it did in 1987, which hasn't been updated because this was from a presentation I did a couple of weeks back. This essentially said that we had one more sell-off in the range before we broke higher. We're breaking higher here today. What this is saying is pinpoints late August, well beyond the UK election. Late August, early September for the top in stock markets. We have a clear, precise date. We have a clear, precise level. So when you look at what happens there, it's going to go back to possibly beyond the start of the Trump trend. That's beyond 2032 on the S&P. Then if you go back to the UK chart, you can understand what this sell-off represents. And if you have that underpinning the UK FTSE, you can expect the dollar to weaken significantly. And that will be the cable trade. It's not just a positive cable, sterling UK related, it will be dollar weakness. So that's how we're going to trade it. If you notice at the bottom throughout this whole presentation, there is a chart available as and when markets present themselves, the opportunity presents themselves, like today. It's been a very busy morning. One reason I'm a little unprepared for this webinar, apologies for that. And try and time it and fine tune it to present ourselves with the best risk return, the best probability, so our payout at the end of the day is as high as it possibly can. And since we launched a year ago, we're up over 140%, so we must be doing something right. And thank you, Simon, for your patience, and thank you everyone for listening today. And my last words will be my pleasure. My last words aren't going to be anything about Matrix. My last words are going to be like talk.
Thank you.
Thank you.
Ed Matz, thank you very much indeed from Matrix Trade.